We are seeing a once-in-a-lifetime event unfold in front of our eyes in the stock market right now. In this video, we're going to go over what's really driving stock prices right now, what to know going forward in terms of the biggest risk factors, and how to capitalize off of this overall giant opportunity. So let's get right into it. We can see by looking at the S&P 500 over the past couple days, it has been popping up after a pretty brutal CPI report last week. Now, if we zoom out a little bit, we can see that the stock market obviously has had a pretty rough year, but over the past couple weeks, the sell-off has been very accelerated to the point where we're seeing some stocks actually into some short-term oversold territories. But what I'm really seeing is, and this isn't really talked about too much, and this is actually pretty interesting, what we can see on the chart right here is the percentage of stocks above their 200-day moving average. And what I like about this data set is that it tends to be very mean reverting. It's not overly complex, and it actually provides useful information. So check this out. What we're seeing on the chart right now, like I said, is the percentage of stocks above their 200-day moving average. Right now, that's around 20%, which historically is very low. It shows that a lot of stocks are at very low levels, and they're at levels a lot lower than what they should be on average. Now, what's cool about this is if we just draw, let's just say a very, very simple, you could call it a support and resistance, but it's more of a range between, let's say, 95% and let's say 10%. Most of the time, we can clearly see that this data set is between this range. There are a couple instances, let's say in the very beginning of the pandemic in 2020, where we had 3% of, or we had 3% of their stock, 3% of stocks above the 200-day moving average. But for the most part, the data set stays in this range, and it's not just some random BS. It tends to be pretty mean reverting, you can say. So if we go through this data set, for the most part, it just bounces back and forth between the high and low of, let's say, 9 and 95. That's what happens most of the time. And if we look even further into what's happening right now, we can see that the current percentage is around 20%, which, like I said, is very low compared to historical data points. So if we go back in history and see what happened in the past when we were in this situation, let's see what happened with the S&P 500. So, not trying to sound too confusing, but long story short, we have 21% of stocks above their 200-day simple moving average right now. Let's see what happened in the past when this happened. So we could see there was actually a prime example recently, right in June, the end of June of 2022. So let's go to the SPY. End of June of 2022. Let me circle it right here on the chart. This is where the SPY was, right? We're in the same exact scenario right now, but there's more examples to cover. So let's say we go back to the breadth indicator. Oops, and then let's say we zoom in on another example, and that would be the middle of March of 2020, right? So let's go to the middle of March of 2020. And here we are, basically the bottom, right? But let's go and see even more examples, right? So let's go back to, let's say, let's say we go back to December of 2018, the end of December of 2018, and we go back again, right? End of December of 2018, here's where the SPY was, right around here, right? And I can go back and do this for every single instance that the breadth indicator was this low, but I think you guys get the point. Most of the time, when we have this many stocks below their 200-day SMA, the stock market tends to bounce back, right? And you can go through this data set as much as you want, right? The trend is very consistent, though. When we have this many stocks below it, they tend to see a bounce back up. That doesn't mean it's a bottom, but in the short term, stocks tend to see a bounce back up, and that's what we're seeing right now. Now, if you're someone who's you know what, there's no way stocks can bounce back up right now, one thing I want to bring up is sort of a counter argument, is one of the biggest risks to the economy overall and the stock market is inflation, right? We want to see inflation come down, and we want to see that happen sooner rather than later. On Thursday of last week, so October 13th, we had inflation get reported, and it was not what the market wanted to see. We wanted to see lower inflation than that. it's just not decreasing quick enough, and that was bad news. And guess what happened? The stock market popped back up anyways. Like, yeah, it dropped down for a second, but it actually ended up the day very strong to the upside. So my question to people who are bearish on the stock market for the short term is like, if bad inflation data couldn't bring it down, which is the biggest risk to the economy in the stock market right now, what data are you looking for? And then, to the bears' credit, we are heading into a very, very important 2 to 3 week stretch as we have some of the biggest companies in the entire stock market about to report earnings. So if we look at this, we had Netflix report after close yesterday. So far, it's been pretty good. Netflix stock is up 15% today. That's a pretty dang good start to earnings season. But, as the weeks go on, we're going to see even more and more influential companies report, like Tesla, Apple, Microsoft, Amazon, Google, and stuff like that. So really, looking at the stock market right now, like especially when you look at that breadth indicator, it's giving a very bullish signal. The only thing, in my opinion, that can really stop or like dampen this uptrend is if the earnings reports are bad. Like if we see a brutal earnings release out of Tesla or Apple or Microsoft or Amazon, that can be a game changer, But besides that, in terms of like other signals, they are looking pretty bullish. So keep an eye. Earnings will be very, very important. A lot of people have been calling for like an earnings recession, which is possible, but so far the past couple weeks have been pretty good in terms of earnings. And I know Procter & Gamble is more of like a defensive company, but they reported better earnings too. What I've been reading with a lot of these earnings reports is just that the dollar, by it strengthening so much, it's hurting a lot of these blue chip companies' business overseas, which makes sense, So in a perfect world, we would love to see the dollar come down, have these companies report strong earnings, and that would be an awesome sign for the market. But another very important risk with the whole situation going on right now for the stock market and the economy is interest rates, because they're just rising at just a crazy, crazy, crazy pace. And this is, basically the only time in history where we've seen such a large increase in yields or rates like ever. So check this out. We can see from Compound Advisors, we have data going all the way back to 1928. 1928 to today. We can see this has been like the worst year for bonds ever. And just so you guys know, when bonds go down, that means their yields or rates go up. So like, for example, we can see on this chart right here, treasury yields or treasury rates are going up, but the bond prices themselves are actually going down. And these rates tend to move up with mortgages and all those other types of interest rates. So keep that in mind. So basically, over the past 2 years or so, we've seen mortgage rates go from like 2.5% to 3% to over 7%. It's fine that mortgage rates and interest rates are increasing. It's actually a good thing because it'll slow down inflation, but they're just rising so much and they're not really showing signs of slowing down, which is the concerning part. So normally like bonds are like safe haven investments, and it's like when you have bonds down 18% in a year and decreasing every single day, that's pretty alarming and it's scary because the lower bonds fall and the higher rates rise, the worse it is for stocks, especially when it's in like a volatile extreme way like we're seeing now. It would be a different story if we were slowly seeing bond rates slowly increase, but like this move is like nothing we've ever seen before, which is just, it's crazy. Like it's honestly, it's just crazy. Like we've never seen bonds move this much this quickly. So ideally what we would love to see is yields start to fall off a little bit. That'd be awesome for stocks and it'd be relieving for anyone buying real estate or anything like that in the short term as well. So really going forward, the main things I'm looking at are definitely yields, especially like the treasuries. That'll be huge. We want them to start to calm down a little bit. Of course, we want to see inflation calm down. We want to see some good earnings over the next couple weeks or so. We have some big companies set to report. If these are bad, it can really set the tone to the market for the downside. But if they're good, it could obviously be a booster to the market to the upside, just like we saw with Netflix. So keep that in mind. Additionally, we would like to see the dollar calm down a little bit. It has just been strengthening so much lately, where it's hurting a lot of these companies' earnings. to the tune of billions of dollars. So keep that in mind as well. Looking at the breadth indicator one more time, it's flashing a very bullish signal right now. Most of the time, we do not see this many stocks below their 200-day SMA. And looking back throughout history, it's been a pretty reliable indicator, not only for bottoms in the market, but also for tops. Like, this indicator has also signaled the top. Well, it's not the exact top, but it's signaled a pretty good exit for the market overall in April of 2021. So if we go to the SPY, go to April of 2021. Let me pull it up right here. April 2021. It wasn't a perfect exit signal. No indicator, no breadth indicator, nothing like that can signal the top perfectly, but it did a pretty good job overall, So that's why I like to look at it. It's consistent, it's not too complicated, and it's just reliable in my opinion. So the next couple weeks will be so important for the stock market, especially with these earnings reports. It's going to get crazy. So I'm very excited. Let me know your guys' thoughts on the market overall right now and just your opinions going forward, because I know there's a lot of differing opinions, and it's just we're at a key level. We're going to see a ton of volatility. If you guys are new to the channel, make sure to subscribe and check out this video on the screen right now. It goes over a pretty cool reason as to why we're seeing the moves we are in the stock market right now. It's awesome.